Now, in this segment, we're going to go abroad and look at what's happening around the world from the point of oil and refined products. And I think this is a good chart just because it shows the what Saudi Aramco did and Saudi Arabia did in general on pricing. And this is just looking at light, so you get an idea. Now, this is looking at the last 10 years of OSPs, or official selling price, and you can just get an idea of how elevated it is versus historic. So this is going to make their prices very expensive. So we will start to see some of the drop in what people are purchasing. That's going to push a bit more towards West Africa, a bit more towards Latin America, because I mean you're looking at $9.35 above Oman, Dubai, and we'll show Oman, Dubai so far, and it's tightened versus dated Brent. It's only about, I think it's $7.5, $8 premium. So now you're starting to see that things are flipping a bit, and this is, I don't know if they did it on purpose, if they expected dated Brent to remain strong, but again, this is going, and also when you look at Asia, I can buy this, or I can pay up relatively speaking, and spend $34 below dated Brent to get Urals, or look to pick up some cheaper ESPO. So again, these are going to be some of those key things when you look at the Middle East, and I would assume Iraq and Kuwait and UAE follow suit to a point. But do they try to undercut a bit, just given where the elevated prices are? Because again, this is going to be very strong given where the rest of the market is currently pricing. So crude oil on the water, this is looking at transit and floating storage is back up. You can see that seasonally adjusted speaking, and obviously it's not as high as 2020 when things went just straight up parabolic, but more along the lines of just staying at the seasonally adjusted, very elevated level. A lot of crude on the water. There are a lot of problems in Asia when you start looking at China, and in terms of lockdowns, some of these lockdowns are actually in some fairly sizable oil import centers. You have Ramadan, which has slowed things down a bit in some of the other ports. And then obviously you have the floating storage and some of the other slowdowns when you start looking at just what is demand looking like, which is why we do continue to see some of this in the market. But when you also look at purchasing and you look at different flows, if we're not going to go to the Middle East, where are you going to go? And that's going to, again, put more crude in transit, which is why when we look at in transit, obviously outside of 2020, we are now back to those seasonally adjusted highs. And that's something where we see it staying elevated, not so much going up much more. We could get to a new high for 2021. But again, we're just going to stay elevated going forward. And if you look at seasonally speaking, you normally have that kind of dip. And we just don't see that, as miles per ton are picking up a bit just because they're trying to move things. Urals coming all the way over to Asia. That's a long trip, but again, at this price, it makes sense. So that's going to increase the amount of crude that is currently in transit, keeping things a bit elevated. So the longer things are in transit, the less time that they're in storage. So again, you're going to start to see this, as we've been saying, just kind of go sideways. And it's just going to be timing. They're trying to time it the right way in terms of making sure that there's a minimal amount of floating storage, kind of waving things through. But just given where storage is in Europe, where storage is going in Asia, you're going to kind of see this pivot where Middle East storage has come down. We expect Asian storage to go up, in relative speaking, and then West Africa starting to come down, which will help keep this kind of, let's call it, just stable at these levels, which will be below 2021, but again higher than the other several years. So crude oil exports here, you can see that they hit 3.69 million. That's going to remain, as we were saying, between that 3.3, 3.4 on a 4-week rolling average. Gasoline had a big increase of 372,000 barrels a day of exports. That's 303,000 above the 5-year. Disti, same thing, increase of 122,000. 258,000 above the 5-year. Given the shifts, gasoline, we have a lot of gasoline. We have to get rid of some of it, especially winter grade. So that's where we typically see a bit of this excess coming through. But distillate is the point where we were talking about. Pad 3 has enough distillate. They're fairly in line with the 5-year average. Pad 1 does not. So it doesn't make sense, and just based on how healthy the pricing is for the diesel market. Does that mean that we're going to continue to see those exports? And I think the short answer is yes. And it could also help by the more we send to Europe, the more they'll send into Pad 1 and kind of help balance some of that when you start looking at exports. Propane, LPG in general, up 140,000 barrels a day at 1.2 million barrels a day on average. Again, that's going to stay strong. It's going to stay well above the 5-year average, just given where the demand is in the market. Gasoline, here you can see that we had that nice spike. We just expected to kind of be that elevated, and they're always going to be spikes just based on timing of when things are moving, when they're released. So we'll come back down, but again, still stay at the very high end of the cloud and well above the 5-year average. Now, when we look at Disti, here you can see that there's going to be this drop down into the 5-year average. But again, still stay elevated, still stay above the 5-year, just kind of well within the top end of that cloud as well. Ethane, can't stop, won't stop. We still see this staying strong. Again, still going to remain elevated, still setting new records. And it may come down just because of the lumpiness of it, but still just continuing to print new highs. Crude oil, here you can see kind of that trend back up. And as we were talking about with what Saudi is charging now, it's gonna pull more U.S. crude into the market, and we expect that to continue to be the case, moving us, because remember what we were thinking that 3.1 million was the right number for that 4-week rolling average. Here we're expecting something much closer to 3.3 and 3.4. You know, when we start looking at kind of up here, it's going to be that 3.3 million barrels as things still remain elevated. Now, when we look at propane, propylene exports, that LPG, again, just staying strong above the 5-year average. The low ends will be right at the 5-year. High ends will be well above, setting new records. Here's when you start looking at the Dubai versus dated Brent. We're right at about $7 to $8. So when you think about what Saudi did, which is now $9 above Dubai, well, dated Brent is now more competitive, or getting more competitive. Obviously, you have insurance and shipping and all those other fun things. But again, you're getting more into, well, now I can start picking other things because the Middle East is no longer the cheapest, which will incentivize a bit more buying, from West Africa, from the U.S., and that's going to continue to see things move into the system. Refinery margins, you can see that they're increasing throughout all of the cracks in Singapore. Hydrocracking, still robust. Again, that diesel cut. The biggest issue right now is how do you manage your gasoline output, and that's going to be something that we're going to talk about in a minute. But so far, again, the Disti crack is still supportive, still keeping things moving through. And when you look at it against historics, you can see just how elevated it is and why we're going to continue to see activity. You know, the biggest problem is going to be, where is cost? Obviously, natural gas prices continue to surge. I mean, Henry Hub is over $6, almost. Right now, it's at $6.23. So when you factor in LNG, shipping, everything else, the input costs are so elevated that the crack has to be this high, which again is going to continue to put pressure on shipping. It's going to put pressure on the consumer as the input costs remain elevated. Now, when we start looking at different prices, this is where things get very interesting. And I saw some of the other things come through. So let's look at where things are ending up at this point in time. So now when we look at just spare capacity in Russia, because I think this is a key piece, and we're going to talk about it in our insights. But it's getting crowded, and when you look at the spare capacity, so spare storage capacity at Russian oil fields is at its lowest in 2 months, and that is going to continue to be an overhang, and why they're trying to accelerate some of these barrels into the international market, no matter really what the price is, because they have to maintain this storage in order to keep production where it is. So Nigeria, you can see, took exports higher in May. The same can be said for Angola, as we've had that step up. Norway, same thing, but again, fairly stable. But then when you look at Russia, Russia for April has increased their exports to really a recent high of almost 4.5 million barrels a day, coming back to making sure that that storage is clear and trying to just keep those barrels moving off the coast. Now, when you look at Libya, as we were saying, it's going to stay right above 1 million, probably stay about 1.1 million. The bigger issue now is when you start looking at pricing. So Exxon reduced its offer for Angola's PAS floor, and we'll look at different price metrics. So Exxon offered 950,000 barrels at $1.55 less dated Brent. It was as recently as negative 80 cents. So you're getting that move down. Total took down Usain to 5 cents more than dated Brent. It previously was 70 cents above. Vital offered 1 million Usain at $2.50 more than dated Brent, which is a similar cargo, sitting at about $1.95. So again, it all comes down to kind of what are we seeing, what kind of grade do we have. Demand from China's teapots for medium heavy grades from Angola or the Congo was muted this week, as their margins are getting just crushed in the teapots, which we'll talk about at the last slide. When you look at teapot refinery run rates really dropping, and again, that's going to lead to some additional pressure. Senegal, same thing. Crude for a 7.8 loading offered at $1.20 more than dated Brent. It was $1.60. Girasol was at $3.50 more than dated Brent. It's at $3.20. When you look at PAS floor, was at $1.60, now is at $1.20. Again, all of these compression points. Trafi offered Urals at the lowest price ever at $34.80. We continue to talk about how we're seeing something off screen closer to $40 below dated Brent. But again, you're seeing a lot of these pressure points. And it's the lowest since at least September 2010, just to give you an idea of the pressure in the market. Seller of Russian crude gave Chinese buyers flexibility to pay in yuan, and this is for May loading ESPO. So again, they're trying to do whatever they can to keep product moving, keep things flowing. Vital offered 1 million Nigerian Usain, again at $2.30 more than dated Brent. It was $2.50. And again, these dated offers continue to fall in general. Now, the other issue that we continue to see is there's Fortes European cargoes have flipped. They were rising and they were as far as $4 above dated Brent, and now they've actually flipped down by almost $6. So again, you're seeing a lot of these movements and a lot of the pressure that remains in the physical market. Here's one of the big issues that we've seen on the total on Genscape side. Here you can see that this is the most amount in storage for 2022. To be clear, this is typically when we start to see those increases, but as you see demand slowing in Europe, we expect this to stay kind of right around these levels. Not so much additional increases, but now this balance between what does offshore storage look like, what is being pulled into tanks, and where is that demand really shaking out. And again, that's going to keep us fairly in line. It's right where we were in 2015, kind of right in the average for 2018 as we continue to see these elevated numbers. On the product side, again, gas oil still still a lot of demand, kind of staying flat here. As we've been saying, we don't expect too much movement up or down, but kind of stable at these levels. And it's just because there's still demand out there, but demand is waning, but there's still a supply issue. So again, the kind of these balancing acts are going to keep us fairly fixed at this rate as gasoline continues to press higher. Here you can see gasoline just right at the top of the all-time high. You can see the all-time high was 2018. Right where 2021 and 2018 kind of cross. So again, we're right at the peak, and just given what we see right now, we should get another little increase, making this the most gasoline ever in European storage, which again leads to what we've been discussing on the front of just slowing demand in Europe and other different pressure points. Fuel oil, as we were saying last 2 weeks ago, we expected some additional exports, and it's really going from west of Suez to east of Suez. as middle distillate and low sulfur and very low sulfur prices increase, emerging markets are going to burn more high sulfur fuel oil, and that's what we're starting to see, and that'll keep some of these, not to say that it's going to continue to drop because it'll start to flatline here, but that's going to be one of the bigger focal points. So here's where we normally see that seasonal drop. We had a total drop of about almost 3 million barrels out of Singapore. And a lot of that is done, again, ahead of Ramadan, which has kicked off. So typically now we start to see those slight builds. As we've been saying, on the total level, we're just going to be right in line with the average. So we don't see too much movement up or down. But the movements that we expect are going to be driven by light distillate on the residual fuel side. So here's where the residual fuel, the light distillate still at the high end of capacity. We expect that to continue, again, to spike back up and just stay kind of the chevron pattern, if you will, and just not so much make new highs, but just hold in at the current levels. So here's where on the middle distillate front, back to the lows, we expect this to stay at the low end. We do have a bit more supply just given where refiners are targeting. But until you get some more of that displacement and some of that demand coming down, which we are, but you're so far down, even if you get some demand destruction, you get some of that increased supply, it's just going to put you, just above where we were in 2008 and 2007, which again is still very low for this time of year. So now when we look at the resid side, that's starting to come back through. So we should see now that the resid has come down, we'll get a bit more in the middle distillate side. But again, this is fairly normal. You can see, it's hard to see a little bit, but it's right at the average. So we expect it to, again, touch the average, bounce, and just stay right around that 15-year average that we see. Now on the Fujairah reported at 15.97 million barrels. Total stocks fell 1.922 million. Light distillate posted a large draw, while middle distillate and heavy had a small rise. Light distillate fell 2.509 million. That brings us to that's the single largest draw. But again, the previous record was 1.989, just to give you an idea. But east of Suez gasoline market was coming under continued downward pressure, with Chinese April exports increasing, raising overall supply. On the demand side, there was an increase in end-user demand for the road fuel, with Indonesia particular increasing demand as it lifts restrictions and Ramadan is ongoing. So again, Ramadan is a big push, obviously, Fujairah in the Middle East. So you try to get some of that gasoline in the market ahead of time. So now as Ramadan is here, people go to their families, they go spend time. As that slows down, that's when we'll start to see those builds. So we do expect to see builds in light distillate, and we do expect to see China increasing their capacity into the market, which is, I think, a bigger concern overall. Middle distillate rose small, 83,000 barrels. The gas oil market remained, again, that well supported as policy developments in Europe are changing. Are we going to get more sanctions against Russia? Where's Russia going to be? And again, that's going to be the overhang into, well, where is gas oil? So again, still a lot of bullishness around the middle distillate front. Heavy resid rose 504,000 barrels. Bunkering activity was picking up with a spike in flat pricing. We did see a quick spike in global trade, and we'll talk about that in segment 1 of the Econ show. But as that kind of comes back down, we do expect to see more builds in heavy resid. And as those prices come down, that's when you're going to start to see that an increased switch of middle distillate to heavy resid on the emerging market front. So now when we look at Brent time spread, June, July, you can see that there's been a big drop in that price. And again, this is kind of the leading the way on when you start to see those prices come down, that you normally kind of see that the spreads start to weaken. So this is something where, not to say that we don't really think it comes down much more, but just kind of holds in, at, I would say, just at about $1 to $1.15 as we go into the next few days. China super tankers, again, still at the high end. We expect this to kind of bounce back and forth but they're going to have to slow a bit just because there's a lot of crude already coming in and they have a lot of issues internally. So as these cargoes show up, they're going to be stuck at the coast. You have your lockdowns, you have your weakening demand. So this is where kind of this congestion is going to result in a little bit of an increase in floating storage, which is why when we look at Asian floating storage, kind of holding firm, we do expect this to trend higher and closer to 2016 levels. The question is always going to be, when does that happen? Is it this week? Is it next week? It will be in the next 2 weeks, if you will, just depending on how it's classified. But again, the boats are on the way and they will show up, which again is going to push Asian floating storage higher. North Sea is right back to the 5-year average. We expect this to remain a bit elevated just because we do have more crude now in floating storage. Prices are getting a bit more competitive, or you do start to see this get exported again. So again, this is going to be something to watch in particular. West Africa, as Saudi Arabia increased pricing, this will be supportive of moving some additional cargoes through. The problem is Asia is struggling, especially, I should say China is struggling. There's a lot of cheap cargoes out there, especially for India and China coming from Russia. They will remain firmly neutral in this, so they will be buyers of Russian crude. And that's, again, so even though we should see more activity, again, it's just going to be a bit muted, which is going to keep us, seasonally adjusted at the all-time highs. We will see some movements, but remember, they're also increasing exports, which will keep these a bit elevated. Middle East, we're floating storage-wise, we're at the lows for 2022. That was what I was saying was going to be a signal for them to raise prices, and here we are. So this is going to, again, increase some of those floating storage, and maybe they're trying to preserve some of this crude for summer burn, but they have been increasing their natural gas consumption. So this is going to be interesting to see what floating storage does now that we've had such an elevated move in price. Europe, big spike in floating storage. This is, again, timing delays, slowdown in demand, and this is something that it'll come down, but it's going to remain elevated, which is why when you look at Europe, we do expect to see an increase in underlying crude storage. These are some of the problems that we were talking about in China. China's Shandong independent refinery utilization rates, it's going to be at a seasonally adjusted new all-time low as we get out of this week. And it's just the lockdowns are hurting the ability to bring personnel in, the ability, the demand internally, which is why they're going to have to start to balance some of that crude. And we will see some of this pushed into the international market. So that's what we have for you today. Hopefully this was helpful. I know everyone's excited to have us back. It's exciting to be back. So if you have any questions, again, you can find me on Twitter. You can find me on the comment sections. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Premier Vision Network.